Thank you everyone for joining. Welcome to another episode of Vyzer Visionaries, obviously sponsored by Vyzer, the ultimate place to track and manage your private and public investments. I'm your host, Lee Tan, and I'm super excited. With me today is Brian Burke, who basically wrote the book on LP investing. And we're going to dive into vetting GPs and operators in these uncertain times. And I personally think it'd be really interesting because Brian has been through a lot. And so, Brian, welcome. Super happy to have you on the podcast slash webinar.
Yeah, I'm happy to be here. This is going to be fun today.
All right, so let's dive into it. And just like housekeeping, this is being recorded. We're going to share it. So if you guys need to drop off or don't worry, we'll share it afterwards via email. Feel free to ask any questions in the Q&A or the chat below. We might wait till the end to answer them, but if it's like really relevant to the specific thing we're talking about, we'll address it as well. All right, so all right, let's kick it off.
Yeah, sounds good. I'll start by sharing a screen. There we go. And I'll just kind of go into just a really briefly my background, a very quick intro on syndication. I think everybody on this webinar probably is pretty familiar with syndication, but there might be some people that find this somehow that aren't as familiar and kind of wonder a little bit about just some really high level basics. So I'll get into that too. I've been investing in real estate for over 35 years. I've been doing it with investor money for over 2 decades. I think one thing I'm most proud of is in those 2 decades, I've never lost a nickel of investor principal, and I really am not ready to start. So knock on wood, so far, so good. I've bought in that time over 4,000 multifamily units, over 700 single family homes, raised over 850 million from investors. Had a lending company for about 5 years that I sold. That company did $2 billion in loan volume. Then we sold that to a publicly traded REIT. And I funded all of this with over 2,500 passive investors, from which I've raised over 350 million in over 40 offerings. I'm also on the other side of the table as an LP investor in real estate offerings, as well as pharmaceutical, oil and gas, agriculture, and lending. So I've been on both sides of the table and kind of understand it from both directions. The team here at Praxis is pretty highly experienced. I mean, one of the things I think we're most proud of is our team has over 106,000 units of multifamily experience going back 45 years. I mean, each of us has been in the business multiple decades. And I think that's kind of one of the things that sets us apart. We have a almost national footprint, mostly in the southern states. These are states where we've had operations. I was mentioning at the very beginning of the webinar that we had about 4,000 units. I sold about 3,000 of them in 21 and 22, right at the peak of the market, which was great timing. I managed to get out just before it hit the fan. Outside of investing circles, I'm probably best known for my book, The Hands-Off Investor. I wrote this book to give passive investors something to refer to learn how to evaluate syndication offerings. And a friend of mine that I worked with when I was 16 years old had lost her entire life savings investing in a syndication where the operator turned out to be a crook. And I just felt like if there was one thing I could do to prevent that from happening to somebody else, then writing this whole book would be worth it. So that's how that got started. Now,
So I want to say one thing if I could, Brian, like because I heard you speak at like one of the bigger pockets event about the book and the background, and I think the context is really interesting because people get into real estate thinking that it's passive, right, and it's hands off, like the flippers and the rental prolongment, like the LTRs, the STRs, all that, and I think it's really important, yeah. So it's about really being a truly hands off investor in real estate, and so yeah, I think that's really on point.
yeah, it is. And part of being a hands-off investor is initially being very hands-on and making your selection of who you're investing with. And that's the one thing you don't want to lose track of, is that you can't be completely passive. You have to make really good decisions on who your partners are, and then watch your investments and make sure they're headed in the right direction.
Right.
So just really quick on syndication, what is a syndication if you're not familiar with it? The root word of a syndication is syndicate. And the Oxford Dictionary defines the word syndicate as a group of individuals or organizations combined to promote some common interest. Not to be outdone, however, there is more than one definition. The Merriam-Webster's dictionary defines syndicate as a loose association of racketeers in control of organized crime. So with these two kind of opposing definitions, the one message I hope to get across to you today is that your job as a passive investor is to determine which of these two definitions the sponsor of the syndicate that you're planning to invest with falls in. You want them to fall in the first definition and not in the second definition. So what is a syndication from a practical sense? Let's say you're going to buy this piece of real estate, this multifamily property. You're going to need money. It's going to come from two places, debt and equity. So a syndication sponsor is a company, a person, a group, whatever it might be, that is going to go to a bank and get debt to buy this property. And they're going to go to a group of investors, such as yourself, and you're going to invest with the syndication sponsor, and they will in turn invest that money as the equity portion of this deal so that you can buy this piece of real estate. The investors are hands off. They're not doing the work. The syndication sponsor is doing all the work. They're guaranteeing the debt. The investors, it's kind of like investing in a stock, or maybe even more accurately in a mutual fund, where you have a manager that's buying the stocks and selling the stocks, and you just invest in the fund. There are two types of syndicators. There's one type is an operator. An operator raises money from their investors, and they buy the real estate and they operate it and they manage it, or at least they hire a third-party property management company to manage it. And there's another kind, which is a joint venture fund. And a joint venture fund is someone that raises money from investors and invests in an operator alongside perhaps their investors. You might also have heard these kinds of structures called a JV equity or a fund of funds model. And it's just really important that you understand when you're making your investment, which group of these two sets of investors do you fall under? And I'm going to explain why that's really important later on in this webinar.
I'd like to clarify one thing on that as well, because the fund of fund feeder fund, I heard people like confused about that, right? So the J fee, there's a person that or a company that they're the capital raiser, and they're going to go and help operators like yourself go and raise capital, right? And they can do it either as a feeder fund, right? Because they don't, whatever, they get a group of investors who don't want to put the minimum of $100,000 in a fund or whatever, and they're gonna, raise $1 million, and then it's gonna be a feeder fund into the operator, right? But the fund of fund, what you mentioned, is different than that. And the fund of fund is when you raise a fund of money, $1 million, and you deploy capital across multiple other operators. And so you get diversification and exposure. And I think it's really important because, the terminology of that is so loosely used in our world of private investing that people just don't know the difference. Moreover, I've spoken with people that do JVs, like capital raisers, that won't disclose the operator they're investing in. And I think that's
Right.
like a huge red flag, right? Because you bring more value than just like connecting with someone. You bring value because you vet the deal. You bring value because you get lower minimums. You bring value because you get better fees. You should be happy to sort of expose who the operator is. If you're not, that's a huge red flag. And I'd never invest with someone who doesn't tell me who they're investing with, right? So I just wanted to say that's important at this point.
Yeah, and to just expand upon that, not only is it important who you're investing with, but it's critical because that's really whoever the operator is really who you're investing with. You're not investing with the capital raiser that's raising the money. They may manage the process of you submitting your investment, but they're not the one managing the process of of the real estate investment. And that's really where the rubber meets the road. People in the real estate industry are the most guilty of this offense of saying like, oh, we found this deal, or we got this deal, or we made this acquisition, or we've bought this many units. There's so much emphasis on the acquisition. Like that's the holy grail. Like the more you acquire, the more successful you are. But really the acquisition is a blink in time in the life cycle of an investment. And where all of the action happens is during the ownership period. And that takes a long time. It might be 2 years, 3 years, 5 years, 10 years. That's where everything really happens. So if you don't know exactly who's in charge during that period, then you have no idea what you're investing in. So
Exactly.
that's really, really, really good point. Talking about different kinds of syndications, there's a single asset syndication. This is where the syndicator is buying one property. You as an investor are investing in one property. You can see the financials for that property. You can look at due diligence materials for that property. You know where it is, what it is, when it was built, all those kinds of things. Then there's another kind of investment, which is a fund. And in a fund, you're investing with the sponsor and they're going out and acquiring property. And you may or may not really know much about that real estate. They may give you a buy box and say, we're going to buy class B and C multifamily, between 50 and 200 units, built after 1970 that is in the southeastern US. I mean, it might be very specific, or it might be less specifically defined where you don't really know exactly what you're investing in. So when you're investing in a fund, it's very important for you to ask the sponsors that you're investing with what type of assets they expect to have in this fund and whether or not you believe that those types of assets are a good fit for you. And we're going to get into suitability and fit here in a little bit. There's two types of operators, ones that self-manage and there's ones that use third-party management, and they just basically act as an asset manager. I don't know there's really hard evidence any one is better than the other. Larger investors like pension funds, private equity, they seem to have found through their experience that operators that self-manage tend to perform better than those who use third-party management. And oftentimes those larger groups won't even invest with operators that use third-party management. Sometimes there's an argument where third-party management is good. I know if they have management companies in each geographical location where the properties are located who are maybe really familiar with the local markets, they could say there's some advantage to that. Personally, I like groups that self-manage. At Praxis, we're vertically integrated, meaning we self-manage. It gives us full control over our portfolio, and I think investors like to know who's in charge, and that they can vet those operators as well as their management team. So just something to think about. Now, if you're looking to invest passively, we have a bunch of things that you should look for, and one thing I want you to avoid, and a lot of questions to ask. And I used to do this presentation, I would call it 5 things to look for and 1 thing to avoid. But for the Vyzer webinar, I've changed the whole rest of this deck to say many things to look for, because this is an advanced class. A lot of you invest in syndications. Some of you probably invest in a lot of syndications. And rather than just kind of glossing over some basics as an introductory, we're going to dive a little bit deeper than that. So let's start with the team. This, to me, is the most important thing that you're going to look at. And the main thing that I want to see in a team is experience. And experience comes in 4 basic forms. Market cycle experience, meaning have they survived an adverse market cycle? Now, that's getting harder and harder to find these days, because the last adverse market cycle was in, call it 2009 or 2000, maybe 07 through 11. And a lot of operators started after that time period, and they don't have market cycle experience. And what's happening is they're getting it now, because we're deep in the throes of an adverse market cycle. And so now you're seeing operators that are getting market cycle experience. Some of them are getting this experience at the cost or expense of their current investors. Some will survive and prove that they will have earned investments from future investors, and others will not survive and will lose investor principal, will get wiped out. Some of them will never be seen again. So if they have previous market cycle experience, I definitely look at that as a big plus. Full cycle experience, meaning have they actually bought, managed, and resold a property? How often do you see an offering from someone that they've bought X number of units, but they've never sold anything? So they really haven't proved that they can do much of anything other than buy stuff. And, at the very top of this webinar, we talked about, deploying capital versus making sound investments. Anyone can deploy capital, but it's not until you've sold and returned money that you know if that investment was sound. So that full cycle experience is really important. Local market experience, I think, is critical. If they don't have any idea what's going on in that market, they're not really a market expert, are they? So having that experience is really valuable, and product type experience. If all they've ever done is multifamily and now all of a sudden they're bringing you a hotel deal, is that appropriate for you? Is that going to meet your risk tolerance level, given that they may not have experience in that product type?
I like to say,
Anything else you can think of, Litan?
I think so. This is a really interesting topic, and we could talk about this slide probably for the whole webinar because it is the most important aspect of any investment in general, not just not just like syndication, real estate syndications, like every private investment. Like the team is always like what matters. But I will say that I think experience is important. But I do think that there are new operators, new syndicators that are really good and they have the potential to succeed and to generate a lot of profits for investors that are willing to, bet on these like new horses. I agree it increases the risk, but it doesn't mean they're bad. As long as it's transparent and you know who these people are and you trust them just from a personal level, but also like they're gonna do good operational side. And you have the benefit inherently in the deal that represents that low experience in terms of whatever fees, waterfalls, hurdles, prefs, protection, like there's all this stuff in there, and that's okay, right? I'm just saying it's like you need to take it both into account, right? Because on the flip side, many times you're going to invest with the large fund, like the Blackstones, right? The BlackRocks, the KKR, like the big PEs that have a ton of experience, but like you know you pay for that lower risk with lower upside usually. So I'm just saying like it's okay to I think it's okay to invest with both the really experienced operators and also less experienced operators. At least you know what you're getting into. Does
Yeah,
that
and
make
I think that's the critical piece is you know what you're getting into, and that the risk is appropriate, or the returns are appropriately sized to the risk that you're taking, right? And it's a totality of the circumstances. So if you have a group that doesn't have much experience and they're showing you this deal, they better check every other box, right? And
right?
you're gonna want to dig a little deeper to make sure that everything, all I's are dotted and T's are crossed.
I mean, because I've met active real estate investors, like people that have flipped hundreds of homes, that have whatever managed rental properties, built whatever. They've done a lot of stuff, and now they want to up their game because people have been wanting that to invest with them, right? And so they want to create a syndication. They want to raise money, and they think they can. They have different type of experience. They might be a good operator to invest with, obviously appropriate risks. That's one thing. Number two, um, I think the product type and locality is super important, especially link to your previous slide about funds, because if you're investing in a fund that's going to acquire properties across different markets and different asset classes, the team needs to match those, right? I mean, I think it's super important. Um, so yeah, that's all I'd have to add here about this slide.
Yeah, and that's a good point too about funds, right? If you're investing in a fund, this team page that we're talking about here is critically important because you don't have any access to what real estate is being acquired. So you're entirely trusting the team. So
Right.
investing in a untested sponsor in a blind fund, to me, would be a non-starter. Now, some investors, maybe that fits their risk tolerance, but that would be a very steep hill to climb. If you're going to invest with a inexperienced operator, you should have a chance to see exactly what real estate you're buying, and what the financials look like and everything, and do your own analysis.
Right.
Another thing you're going to look for in the team, though, is their track record. And this kind of goes along with the experience. How have they done? How have their past projects done? How are their current projects doing? I'm going to touch on that a little bit more in detail in just a minute. And then, do they have a brand to protect? I mean, people talk all the time about having skin in the game, and it's often skin in the game is often defined as having money in the deal. But are they really invested in this? Is this like a one-time guy that's bringing this deal that if it fails, they can just, disappear, come back in 2 years with a new flag, a new brand, and a new logo and try again? Or is this somebody that's going to fight to the death to make sure that this deal succeeds? Because if it doesn't, they're toast. And that to me is extraordinary skin in the game when they are defending their reputation and their brand.
100%.
Suitability is another test you should be looking for. Does the investment meet your needs? Like, For example, if you're retired and you need cash flow, does the investment have cash flow? If you're young and just building your wealth, does the investment have capital growth, or is it just a cash flow deal? You want to find investments that are suitable and meet your needs. Also, ones that meet your risk tolerance, kind of to our discussion just a second ago about new sponsors. If you have very low tolerance for risk, investing with a new sponsor is probably a non-starter. And also investing in a ground up development might be a no-go for you if you're risk averse. But yet, if you have risk tolerance and you've got a lot of life ahead of you to make back losses, and this is just a small part of your portfolio, or this is risk capital, it's coming out of that bucket. Does this investment match your risk profile? Does a Class A stabilized multifamily meet the risk profile for you? If you're looking for high capital growth, high risk, probably not. So make sure that it's meets your needs, or you're not going to be happy when you get halfway through the investment. And then finally, liquidity or lack thereof, that has to be okay with you. You don't want to invest short-term money in a long-term deal where you might need this cash in 1 or 2 years, and you're buying a parcel of real estate to improve it and sell it at some point down the line that might take 3, 5, 7, or 10 years. And you can't get that money back. There's no way to access that cash. And the worst thing for an investor, and in fact, in my mind, the worst thing for a sponsor, is to have an investor or be an investor that needs that capital back for some reason, and you're midstream in a project, because there's just no way to get that liquidity. So having that match is really super important. You want to look at the market, and I always say that there's 3 main things that drive the value and the income of income property, and that's job growth, income growth, and population growth. If you're investing in a place that has population losses, job losses, and no income growth, the prospects for that deal being a good one are slim unless you found a real needle in a haystack. So markets will give you tailwinds, or they can give you headwinds. Depending upon the investment strategy, tailwinds usually are a lot better. Now, that caveat, or this concept, comes with one caveat, that those 3 things should be built on a foundation of economic diversification. If all the job growth, income growth, and population growth is being driven by only one industry, that's an additional risk factor you really have to consider, because if that industry has some kind of change, whether it's economic, regulatory, or whatever, you could quickly find that this investment moves against you, and you don't get the results you were looking for. Next is you're going to look at the real estate, the location, the quality, and the strategy. And I kind of put these 3 together because they all need to fit, right? If you got a property that's in absolutely tip-top shape, there's nothing you can do to improve it. So quality, check. It's in a great location. So check. And then the strategy is to buy it and jack up the income really quickly and sell it in 2 years. Well, what are the chances of that? Probably not very good. That strategy doesn't really match the location and quality of the real estate. But if you have real estate that needs work, the management is poor, the location is great, but the property just doesn't look good, they can make improvements, the strategy is to get in and out quickly, that strategy might work. Conversely, I look at some of these where you're buying a 1960 apartment building that needs a ton of work, and it's kind of in a rough neighborhood, and the strategy is to hold it for cash flow for 10 years. Well, do you really want to have a subpar property in a declining neighborhood that's probably going to need to be torn down for 10 years? So having all these things fit together is really important. And after you've kind of managed all that, the next thing you really want to look for is threats and risk. Let's turn our attention to threats and risk. One new one, this is one that we haven't really talked about in years that I've been doing talks such as this on track record, is legacy issues. The last time legacy issues was really a part of the discussion was at least 10 years ago. And what I mean here is, when you're checking the track record of a sponsor that you're looking to invest with, and they've got this big portfolio and everything looks really good, what's in that portfolio is really important to understand. I would want to know how many properties in their inventory were acquired between 2021 and 2023. if they have got like the majority of their portfolio was acquired during that time, I have two questions. My first one is I'm concerned about their ability to read the market because that was a terrible time to be buying. You're basically buying at the very top. And second is, are they going to be kind of stomping out fires or playing whack-a-mole for the next 5 years, dealing with over-encumbered real estate that is underwater and has loan maturities and all these other kinds of things, and not really paying attention to this new asset that you're investing in? You don't really want a distracted sponsor any more than you want one that doesn't know what they're doing. So looking at their track record and what their current portfolio composition is important. And also, did they have any sales after 2022? The market really went into decline in the middle of 2022. So if they had a sale toward the end of 22 or a sale in 23, how did those perform? Did they lose money? Did they just barely get out? What did that look like? That would be really interesting to know how those did. So new things to check on track record we didn't really have to think about 3 or 4 years ago. Other threats are in the capital structure. Pay very close attention to the amount of debt leverage used. The more debt that's in place, the higher the risk. For example, if in the case of high leverage assets, this block on the right-hand side, we got a lot of debt and only a little bit of equity. If the property declines in value by a small amount, it could wipe out all of the equity, versus in a low leverage scenario, it wipes out only a percentage of the equity. Also, you really need to think about what loan maturities they have, and what the loan maturity is of this investment, and how long you have to be able to ride out an adverse market cycle to get through to the other side, to be able to let the asset appreciate and recapture any equity that was lost from a declining market. It's a lot easier to do when you have a lot more equity. The less equity you have, the more pressure you're going to get from lenders to do something about a declining value scenario.
And I'd say one of the main reasons we're seeing like a lot of, you know, headwinds in the market is because operators got used to the low interest rate environment and went more towards the right than they did to the left. And now they're getting, hounded by that. I even say, I mean, we spoke about this before, like, me and two other LPs, we go over, pitch decks from GPs, and we put them also on the YouTube channel. I'll share it afterwards. But like we see like GPs now pushing, like, talking about deals that, they have like a 3% interest rate loan. And that's an asset on its own, right? And you look at it totally differently than what you would look at it, 3 years ago, 2 years ago, when like it was pretty common to have those types of stuff. So super, super important aspect. And I like the way you're presenting it here. It's really intuitive.
Yeah, and the other thing about that is there's a lot of deals that you're seeing transacting right now on assumable financing, where they're assuming a 3% loan and saying like, well, we can pay more for this asset and it's worth more because we have this 3% loan in place. But you also have to underwrite what that asset's going to do when that 3% loan is gone, right? So that thing is going to mature at some point. You're going to have to refinance. What's that going to look like? Are you going to be able to refinance, and how's it going to perform after that refinance if interest rates are 5, 6, or 7% instead of 3%? Just more things to think about. And that kind of goes right into kind of where I was headed with the next element of this discussion is the next big threat is debt structure. And in fact, I think behind sponsorship, debt structure is probably the next greatest risk. I'm going to talk about 3 different types of real estate debt for commercial real estate and what the risks are in amongst all of these. So basically, you've got fixed rate debt, floating rate debt, and bridge debt. There's no free lunch in the world of commercial real estate finance. So it would be really nice to say, well, of course you want a fixed rate loan. That's what you have on your house, right? In 30 years, your house will be paid off, and the entire time you own it, you're going to be paying the same mortgage payment with the same rate of interest. But in the world of commercial real estate, no such similar product exists. All of these loans in commercial real estate will have a maturity date that'll be before they fully amortize. And this is going to lead to you having to choose a risk rather than eliminating risk. So if you get a fixed rate loan, there's a concept called yield maintenance risk. And what yield maintenance is, it's a prepayment penalty. And when you're taking out a fixed rate commercial loan, you're essentially telling the lender you're going to get all your interest for the entire loan term. So if you borrow a loan for 10 years, and you pay it off in 2 years, you still owe them the other 8 years of interest. I mean, in the simplest terms, that's what it comes down to. So if the plan is to buy this property, fix it up, renovate it, and resell it in 3 to 5 years, and it has 10-year fixed rate financing, there's going to be a massive prepayment penalty when that loan pays off, or there could be, depending upon what the economy looks like at that moment. And that yield maintenance risk is significant. And some sponsors will put this in their underwriting, and you'll be able to see an estimate of what that yield maintenance risk might be, and it might be plugged right into the numbers. Others completely ignore it and pretend like it doesn't exist. And it's really important for you to understand as a passive investor, does the financing match the business plan? And are those costs factored in? Another type of commercial real estate loan is a floating rate loan. And the same agencies that write fixed rate loans, Freddie Mac and Fannie Mae, they also write floating rate loans that are long-term loans, 5, 7, or 10 years, just like the fixed rate are 5, 7, or 10 years. The difference with a floating rate loan is they don't have the yield maintenance risk. It's a 1% exit fee, and you can pay that loan off at any time after the first year. So if it's a 10-year loan and you fix the property up and the market is great in 2 years and you sell it and double your money, you can do that and you have no prepayment penalty other than that 1% exit fee. But you have to trade that privilege for the risk of interest rate risk. And this is what we're seeing in a lot of cases right now, is you'll have interest rates rose really quickly, really high, really quickly, and the floating rate loans are getting creamed. At the same time, 3 years ago, the guys with fixed rate loans were getting creamed by yield maintenance when they would go to sell a deal and they'd get a bill for $2 million at the closing. And they're like, well, we didn't count on that. That's not such an issue today, but the floating rate is an issue. And so you have to choose between these two risks. And then there's a third type of loan, which is a bridge loan. A bridge loan is a loan that's made for a shorter period of time to accommodate a business plan where they're going to go in, renovate, stabilize, and then resell. These loans have maturities that tend to be 3 to 5 years. Oftentimes they're 3 years with 2 one-year extension options that are not guaranteed, by the way. These loans tend to be at high loan to value ratios because they're basing the value or the loan amount off of the future value after you make renovations and improve the income. And they also have floating rates. So the threats about a bridge loan is you get all of these different risks. You have maturity risk because if the loan matures in 2 or in 3 years, that's the blink of an eye in the world of commercial real estate finance, and that will happen very quickly. If it matures in a down market, you're in big trouble. And we're seeing a lot of that happening right now. That's why a lot of these syndications are falling into problems, is because they've got loan maturities. Interest rate risk, they have the same interest rate risk as floating rate loans from the agencies, except the interest rates are even higher because the spreads are even wider. And you also have the high leverage risk, where, before when we were showing the blocks with the amount of debt versus the asset value, bridge loans tend to be very high in loan to value ratio. So there's all kinds of threats that could come from bridge loans. Be very careful when making investments like that. There's other threats in the capital structure, not necessarily debt, but in the capital structure, you might see a variety of other things like, in the simplest capital structure, you have senior debt and your common equity. You're investing in the common equity. The senior debt is the lender, the bank, the agency, whoever they might be. That risk is a little bit more manageable, especially at lower loan to value ratios. But other things can be inserted into this capital stack that can create threats. Mezzanine debt, and subordinate debt, which are similar to one another, but these are additional loans, like a second mortgage, if you think of it that way. And that adds additional risk. And then the other one is internal and external preferred equity. And what that might look like is they might go to an outside source, like a private equity company, and get preferred equity, which puts them first in line for distributions ahead of you as a common equity investor. And they get first rights for payment of their return, and they get first rights for repayment of their principal, even before you. So in a downside scenario, it's perfectly feasible for the preferred equity source to not only get back 100% of their equity, but also 100% of their promised return, while you as a common equity investor is 100% wiped out. That's completely possible. So you just understand how these preferred equity structures can add additional risk. Now, internal preferred equity, you might see this, it'll look like multiple share classes. So when you go to invest in a deal, they might say, okay, you have a choice. You can invest in class A or B, or class B or C. And the class A might be internal preferred equity source where you get priority in distributions, you get a fixed return, but you don't get any upside. And then the class B is the common equity where you get a preferred return followed by a waterfall and upside, but yours is paid afterwards. This adds substantial additional risk, and you would want to be compensated for that additional risk by additional return. So just another thing to think about. Looking in the underwriting, this is where we get kind of into the weeds of when you start looking at these offering decks. And Litan was talking earlier about how they're reviewing pitch decks from sponsors. And these are some of the things you might want to look for in a pitch deck. Is the projected rent supported by comps? Oftentimes you'll see, oh, we're going to go in and we're going to renovate, and we're going to raise the rents to, $2,500. Well, okay, what makes you think you can do that? Is there other properties in the area that have renovated to that level that are able to achieve that? And let's see what those are. And, you also want those comps to be relevant. If this property is built in, 1970 and they've got 5 comps that were built in 2010, that's not a rent comp. So, you want relevant comps that are close by, that are proving that they're going to be able to achieve those rents. These are some rent comps I harvested out of one of our old deals that I think we either own or we still own this one. And so, we've got all these different rent comps. The comp average was 1,900. We were projecting to bring rents up to 1,800 in 1 bedrooms, and then 2 bedrooms was a little bit more. And, we have a graph that shows what the comps are getting, and then a red line to show what the average is. And then the 2 blue lines is the current rent at the top, and then our projected new rent is the second blue line. So is the sponsor supporting the rent with comps, and are they showing it to you in a way where you can understand it and evaluate it yourself? One thing you'll also see is like the size being way different. Like they're projecting to get just as much rent as the comps, but their units are 200 square feet smaller. Well, it's not likely they're going to get the same rent. So you want to look at all those different factors, like the quality of their properties, the size, all those different things.
We've seen like it's crazy. Like so many decks don't even if they talk with comps, it's like high level, and some that do, it's like doesn't make any sense. This is such an important aspect of it. I don't know if you dive into the pro forma and the business plan, which is also an important point that some decks don't even have, and some do, and it's like really detailed because you might show the comps of like what you're expecting in terms of increase in rent, but you're not showing the plan to even reach that. Like, what are you doing? Are you renovating? What does that look like? So yeah, it's super important.
Right. And how much is it going to cost you to do that? And did you account for all those costs in your financials? And so one thing that's important, and I don't really have a slide for this, but we'll kind of get to this point, but you want to be able to go through a slide deck and look at every single dollar and watch its entire journey, right? So when money comes in, it comes in from rent, right? So you want to see what's that rent going to be and how do we arrive at that number? And then what happens to that dollar? Some of it gets spent on expenses. Well, what expenses are there? And you want to see that they have that. And then after the expenses, there's debt service. You want to see the debt services in there. And then there's distributions. When a distribution is made and asset management fees are paid, are you seeing the money flowing from there? And then finally, it gets to a waterfall where it's split. I'm going to kind of walk you through this whole process, but you want to be able to track that dollar all the way from the tenant paying it to the property to the sponsor paying it to you. If you can't follow the dollar all the way through and there's a break in the process, which you'll often see, that's a problem.
Right. All right, just a
So,
question, Brian, just like, being minded to time. So we have like 18 minutes left. Is
got
there
it.
like,
We're gonna make it.
I want to leave time for questions. That's it. So if anyone
We'll
has
make
questions,
that too.
like feel free to ask them already so we have them set.
So the next one is assumptions. They're going to have a rent growth assumption in there. And is that rent growth assumption reasonable? And also, where did they come up with it? Did they just make it up? Or is there some third-party data that they're using to get their rent growth assumptions? And are they willing to share that data and report with you? Physical and economic vacancy factors. Oftentimes you'll see people just, oh, well, there's the 5% vacancy. Well, what kind of vacancy? There's physical vacancy, there's concessions, there's bad debt, there's non-revenue units, which are like model units. Are they accounting for all those different things? And what vacancy factor are they doing? So this was another one I pulled out of one of our decks that, in this case, the property on the T12, which means the trailing 12 months. So this is the seller's numbers, 12. They were at 9.47% vacancy. You can see that right here. So then, we're looking at by year 3 being at 11% total vacancy factor. A lot of times you'll see people really try to squeeze the vacancy like, oh, we're going to run it at 6%. Well, no, you're not. You're going to try, but you're probably not going to get there. So are those vacancy projections also reasonable? Another big one is this is like one way you could kind of tell a bad underwriting in like 2 seconds is watch out for a large jump in first year income. I harvested this out of some slide deck somebody sent me a while back. And, you notice that in 1 year, they're going to raise the income by almost $600,000, which is almost 15 or 20%. Good luck with that. That's very unlikely to happen. If you see large jumps in that first year, it's very likely they're going to miss that target. And that to me would cause me to question all the rest of their underwriting. If they don't know that already, then what else are they missing? Just looking at one of ours, here's our first year income comparison. You notice ours actually went down. We're assuming, when we go in and start to renovate, you're going to have some vacant units, right? That you're going to be renovating. So I think the income is more likely to go down. If you see a decline in first year income, I think that's going to be a lot more reasonable assumption than a jump in first year income. Also, another one that's easily manipulated is the exit price. This is a major component of the return of your investment is what they're going to sell this property for. And how do they get to that price? How do they get to the income in which that price is based off of? And what cap rate are they using to calculate that exit value? Both of those two figures can be easily manipulated and financially engineered to back into a return that sounds attractive. And the only way you can tell if that's what's happening is to look at the assumptions that are being made and determine, is this cap rate a reasonable cap rate? And is that income that they're projecting for that year achievable? And how did they arrive at it? And you have to follow the numbers all the way through.
How does an LP investor know if their cap rates are reasonable?
One thing you'd look at is what cap rate are they buying at? And what cap rate are they projecting to sell for? And cap rate is a thermometer for the market, basically. So the hotter the market, the lower the cap rate. So think about what the market is like today. And you think like, well, right now, today in 2024, the market's really not all that great. Interest rates are high. If you're going to sell in 5 years or 7 years, is the market going to be better and our interest rates going to be lower? And if you believe that they are, maybe a lower cap rate than they're buying at could even make sense. I mean, there could be a case to be made for that. But oftentimes the opposite is true. You're buying and the market is really kind of strong. That's why you're investing in multifamily or whatever asset class you're investing in is the market is strong. So cap rates are kind of low. And you would have to assume that when you go to sell, it probably won't be as strong and those cap rates should be higher. That's one way. Another way is you can ask to see the appraisal for what the property is being appraised for, what's its cap rate today, and then you got to unpack whether or not you think the market's going to be stronger or weaker at the time of the sale. And this is all a big wild ass guess. And the biggest problem with this whole thing is the only guarantee is that everybody's going to be wrong. The NOI will be different than what they're projecting, and the cap rate will be different than what you're projecting. You have to make some assumptions and some guesses, but you can also spot some really egregious assumptions and guesses that are way out of line. And that's the only thing you can look for is to try to find them when they're way out of line.
Right.
Another one is, are they adjusting the property taxes for the resale? In a lot of jurisdictions, when the property sells, the assessed valuation is going to be reset to some new amount. And do the property tax expenses reflect that potential jump in tax revenue? If you don't see a jump between previous and future property tax, you would want to have a conversation with a sponsor to find out why. Is there a tax abatement in place that has an agreement with the government? How long does that last? Or is this being purchased in a jurisdiction such as Arizona where they don't reassess on sale? It might be perfectly logical explanation, or it could be that the sponsor just isn't doing their underwriting very well.
Right.
Is the sponsor raising enough money? This is a sources and uses chart that came out of one of our offerings from a while back. And there's a lot of categories of costs here. And oftentimes sponsors will forget about things like the first month's debt service is paid at the closing. There's no cash flow on day one. There might be by day 31, but there's not by day one. So where's that money going to come from? Are they raising enough money for all of the little things? The first year's insurance will have to be paid in full for the entire first year. Is there enough money in there to accomplish that? I once had somebody send me a deck to look at, and they said, "What do you think of it?" And I said, "They're not raising enough money." And so I ran into the guy at a conference, and he's like, "Oh, I sent you a deck one time, and you gave me some feedback on it." And he said, "Oh yeah, what'd I say?" And he goes, "You said they weren't raising enough money." And I said, "Well, what happened?" He said, "They came back later and asked for more money because they didn't raise enough. They didn't even have enough to accomplish the unit renovation because there were so many other costs at the closing that they weren't anticipating. They burned through all their cash."
Well, all right. So I know there's a lot more I want to ask on that though, because you know, and I will sort of say two things. One, we're already I've heard a lot of really amazing things of practice over the years, just like really good stuff. Even when things aren't going as planned, like you guys dive in and make it work. And that's you mentioned at the beginning, you've never lost investors' money. But the flip side of that, I'm not saying this is a bad thing because it happens. You are having like a capital call, might have a capital call coming up this year for one of your deals. Is it because of something here, or is it because of something like totally different that you didn't anticipate?
No, that goes back about 8 slides about interest rate risk. So we haven't issued a capital call, and we are very unlikely to issue one this year. If we do have to issue one, it'd be sometime next year, we think.
Okay.
And it's all as a result of increasing interest rate risk, because we had to make the choice when financing, which risk do we want, yield maintenance risk or interest rate risk? And I've always chosen interest rate risk, because yield maintenance risk would have been a death sentence for a lot of our deals in the past. We renovate and resell, and we do that a lot. And to pay the yield maintenance on those loans would be astronomically punitive. And in fact, there's deals that we had in our portfolio. Had we had fixed rate loans, we wouldn't have been able to sell them, or we wouldn't have resold them. But because we had floating rate loans, we were able to sell them when we produced some amazing returns for our investors. So we chose interest rate risk. All of our investors know this going in. We talk about our finance structure in our deck so that they can see exactly how we're financing, and we're accepting that interest rate risk versus yield maintenance risk. And, rates went up 1,000x, right? The SOFR was at 0.05 when we took those loans out. Now it's at like 5.4. So the increasing debt service is burning through cash. And at some point, we're going to run out of cash. And so we're really fortunate, though, of two things. One is we don't have any short-term financing. All of our loans are 10-year loans. So we can ride all the way through all of this cycle without having to worry about a lender knocking on our door telling us we have to sell. And the other thing is our loans are really low leverage. So that means that we raised a lot of equity. So we can do a capital call for a very small percentage of equity, and that raises a lot of dollars. And I think if we have to do a call, which I don't know for sure that we're going to have to, but it's looking increasingly likely as long as these rates remain higher for longer, which seems to be the policy that's happening. I just kind of my back of the napkin so far, and we're going to do a lot deeper dive on this so the closer we get. If we did a capital call for about 20% of our equity, we literally, if nothing else changed, we could get by for 7 to 8 years with that amount of equity. So versus like a lot of capital calls we're seeing these days where it's like, we need to call 20 to 30% of the equity so we can get through the next year, right? Or so we can buy the next rate cap. And then after that, we don't know what we're going to do. We're in a much better position than that. But, these markets happen to everyone. And even if you own the property outright yourself, sometimes you run into these things where you have to take money out of your pocket to get things all the way
I,
through the other side.
saying, there's always risk involved, and I think you clarified it pretty well now. So I appreciate that. Yeah, I mean, capital calls happen, and if communication is as it should be, and I've heard really good things about communication for you guys, um, then I mean, you just have to bite the bullet if you want to stay, with the amount of equity you have. I'm assuming people who don't put equity back, if they don't want to, put the capital call in, they'll just dilute it, correct?
That's
Or
right. Yeah, we don't have mandatory capital calls in our docs. Some sponsors do, we don't. But you're absolutely right. It's a matter of choosing risk, and it's a matter of investors understanding those risks and putting the money in if they feel as though that's the right move for them to make. We look at it like our job is to safeguard your principal, and we think that's the best move to do it. And I must be communicating it well if you're hearing about it already and we're literally at least 6 months to a year out from even having to do it. The worst thing you can have happen is all of a sudden you get an email saying, we're doing a capital call, send in 20%. And you're like, wait, what? Why? What's going wrong? I didn't hear anything. That's the worst place you could be.
right. Yeah. All right. So we have 6 more minutes. There's like anything like really important you want to dive into before we sort of go into some questions here?
Yeah, let's just get through some of this stuff really quick. You guys already know about this, waterfalls, different kinds of waterfall splits. I don't really know you need to go into too much detail about different kinds of waterfall splits. There's not really one that's any better than the other. There's just different ones for you to consider. Make sure that you understand how it works and that it fits for you. Fee load, you got a bunch of different fees. Understand what those fees are. Make sure that the fees are in the numbers. If they say, well, our fee is this, this, and this, but you look at the numbers and there's no fees in the numbers, then the returns aren't gonna make any sense at all. Another one is that I really want to kind of get into is asset management fee. Everybody says the asset management fee is 1%, but 1% of what? There's basically 5 different ways you can calculate asset management fee as a percent of gross income, equity, net asset value, debt and equity, or gross asset value. But the numbers are way different. You get 22,000 versus 289,000. So understand how the asset management fee is being calculated. Extraordinarily important. And then finally, this is kind of like my last point is on the funds flow. We talked about like a 70-30 split in a single promote structure, but if you're investing as an investor here, you're getting 70% of the profits of the deal. But if you're investing in a joint venture fund to funds kind of model where you're investing at this level, you might be getting 80% of 70% instead of 70% of 100%. So just know what kind of structure you're investing into. It's really important. Sponsor co-invest. People, if you see a large investment by the sponsor and you decide that that aligns your interest and you can skip the rest of your due diligence, just don't be that person, because no amount of co-invest will make an incompetent sponsor competent, an inexperienced sponsor experienced, or a dishonest sponsor honest. You still have to do your due diligence, even if they're making a large co-invest. Don't skip it just because the money's there. Don't chase the shiny object syndrome of just investing with the group that shows the highest projected return. How did they get there? Because making the right choice for sponsors and the right choice for investment is the difference between success and failure of your investment. And you can check out the book to learn all the little pieces about how to put all that together. And let's launch into questions.
So there's a question here from Theo about, do you need to be an expert underwriter to be an LP? Or does an LP need to be an expert underwriter? How trained should one be?
You need to have a fundamental knowledge. And so the way I could best describe this is like you need to be like the building inspector, not like the contractor. You don't have to know how to build the house and what screws you need to, you don't need to know everything about building a house, but you have to know what to look for to make sure that house isn't going to fall down if you're the building inspector. So you have to have some fundamental knowledge of construction. Same thing happens here. You need to have some fundamental knowledge of underwriting and assumptions, and recognizing when assumptions are out of whack or recognizing when something is missing. you can find all that in the book, by the way. It talks about all the different things you should look for, but you don't need to know how to do the underwriting itself.
Yeah. And check out the YouTube thing. We do that. We do that every time we go through a deck. Like we do, the level of underwriting we think an LP should do when they go over a deck and questions they should ask. I think yeah, the book, obviously the fundamentals of it, and you want to be around people that do it a lot.
Yes.
And Vivian, yeah, we'll share the recording of this session. I don't know, Brian, do you want to share the slide deck or you prefer not to? It's your
I
call.
can I can send that to you. Yeah. I can send you a PDF.
So we'll share the recording of this and also the deck. Um, awesome. Yeah. So listen, I mean, we ran through the end of it, and I do think you want to bet on the winning horse. Like, yeah, the operator that you want to know what you're getting into with them. I think also, the beginning and the end of the slide deck, sort of, if I want to relate to that, I think the note I mentioned at the beginning about the experience or the non-experience, um, that should also, come to play in the end of the split, the waterfall as it promotes the pref and all that. I think, we also do the hurdles, and it usually is a lot more investor friendly if it's an unexperienced investor. Like I've seen, 90-10 splits. I do think, and this is really important, like the sponsor operator must make a profit from this. Like they need to make money because it needs to be profitable for them, because you want them to go all in on this and not just like, oh, only if there's an upside. I think that's super important point that a lot of people sort of neglect. I've also seen operators like experience one, and we've also reviewed one of these pitch decks on the show where they don't take any fees. Like there's zero fees, which is all. So it's also a strategy, right? Yeah. Anyway, and we can dive into a lot of really like edge cases, but like this has been really interesting, Brian. I appreciate it. Is there anything you want to add, like to sum it up?
Well, I just think, kind of tying into what you just ended with there, I think is a great segue that you want the sponsor to make money also, because that puts their skin in the game too. And you want them to win because you want to win. And if there's nothing in it for them, you can't win. So just make sure that you're investing with the right sponsors and the right asset that's a right fit for you. And, just watch your risk tolerance versus the risk profile of the investment. If you do all of that, you can be really successful in making these syndication investments. If you ignore all this advice and just say, well, I found the group that has the highest IRR, the biggest co-invest, or the smallest split, or the smallest fees, and that's your criteria, you could miss a lot of really good opportunities, and you could find yourself stuck in a really bad one. So you got to kind of walk through the totality of the process.
Right. Awesome, Brian. Thank you so much for sharing sort of your experience with us and with all of our audience. And again, this is recorded. We're going to share with everyone afterwards. Like, I mean, if everyone wants to reach out to Brian, his information is also in the presentation. We'll share that as well in the email. We do a lot of these shows, a lot of these webinars with really interesting people just to learn more. So feel free to subscribe to us or join our email list, and we'll reach out to you, and check out Vyzer, and also the podcast we do to review decks is super helpful, I think, to other LPs. We have no agenda there other than teach people how to invest better. So thank you all for joining us, and until next time, invest smartly. Have a great week.